Good morning, everyone. How are we all today? I think there's some energy coming back up. I hope everyone's had a good conference day. My voice is kind of giving way, and it's on its last legs, but I'm glad that it's still intact for today's very exciting panel with our three amazing panelists. So just to kick things off, I know that we're slightly behind schedule. My name is David. I'm a co-founder at Drift Protocol. We're the largest Solana perpetuals DEX right now. So I'll keep it super short. Let's get this panel started, and I'll let our panelists quickly introduce themselves, 20 seconds, and then jump straight into it. So Victor, please.
This is very nice to meet you guys here, and my honor to be a panelist right now. So my name is Victor. I'm one of the co-founders and CEO of Kyber Network. So Kyber Network is the APAC OG in the DeFi space, right? We provide decentralized. We provide the Kyber Swap as a decentralized chains. We provide algorithm API for free forever, and we have liquidity protocols which is better than Uniswap, right? So yes.
Hi everyone. My name is Sergey. I'm co-founder of 1inch Network. Actually, 1inch Network was built on a hackathon, and actually based on Kyber, Uniswap, and some other protocols. We invented aggregation among decentralized exchanges to provide the best rates for the DeFi space. To my personal software engineer for 17 years, with also some aggregation experience previously.
Awesome. Hey everyone. I'm Will Corkin. I'm one of the co-founders of Mantra, which is a DeFi ecosystem that's been around for about 2 years that encompasses a validator nodes business, a Cosmos Tendermint EVM compatible chain, as well as a kind of finance section where we're going for international licensing in different jurisdictions around the world. I'm also the co-founder of a company called Soma Finance, which is a US licensed and regulated DeFi platform that also includes a multi-asset DEX that we'll be talking about as we go on.
All right, thanks everyone. Let's dive straight into it. I mean, the panel topic today is the road ahead for decentralized exchanges. And the market has seen quite a lot of activity in the past 6-12 months. So I'll kick it off by asking the panelists, since the bull market last year, have you identified any major changes in the market structure or key players emerging on the on-chain trading environment? And please, anyone, feel free to take this to kick it off.
Let me go first. For sure, very obviously, the bear market is the biggest change, right? The bear markets make everyone more nervous. Everyone is more careful about deploying all the capital, TVLs, and things like that. And also in the space, there are so many hacks, so many incidents. Also, at the same time, there are so many regulations, incidents, right? So the biggest change in our own services is we have to refocus on what the retailers is looking at right now. And what they are doing right now is not really about how to raise with all the trends and all the market movement, not yet. But they are trying to stay back, and they're trying to spend more time, to learn more, to really get back to understand things, because like we have been through the past 2 years with crazy movement, and the speed of the whole space crazy fast, right? So right now the people is staying, and so many people is trying to learn more, try more. That is the. Yeah.
Is that a sentiment you guys would agree with?
So from my side, I can add. I agree. There's like a lot of people who try to onboard. Right now in crypto, here for example, in some shops, I was talking with some people and they said like, I'm looking how to enter crypto. It's a bear market and it's time to build. So like it was before like 2019 when we had started with 1inch. So regarding like market makers and the whole situation in the market on-chain liquidity, actually we have still the same liquidity in ETH. Yeah, I would say if you take a look on the analytics, it's actually the same liquidity. ETH is down, Bitcoin is down, and that's why we have lower TVL right now. Of course, we had some incidents in the last time. Wintermute was hacked, for example, for $180 million because of this tool which generates your nice addresses. It's really kind of insane thing. I personally also was like, I generated also multiple addresses. I had the luck that I had no funds on these wallets. It was only for deploying smart contracts. Yeah, this current situation is, from my point of view, is a good time to build, to innovate.
So I mean, definitely agree with the last statement. I mean, bear markets are the time to build. You know, the people that succeed in the bull markets are the ones that are building in the bear and the ones that survive the bear. But going back to one of Victor's points in terms of the need in the non-fungible bear, but going back to kind of the need and the push for regulation is one of the biggest things we're seeing, both on the Mantra side as well as the Soma Finance side. We've always been, very pro-regulation, pro-compliance, and seen a need for it, even back in 2016 with one of the first projects that I started back then. And kind of one of the USPs that we have with Soma Finance is we actually developed an additional license on top of our broker-dealer to be able to work with, issue, trade in a peer-to-peer manner, and work with digital securities using any blockchain and any reg filing. In the US, we've seen so much coming out with the SEC going after different projects, any of these centralized exchanges even that, there's class action lawsuits that they're trading unregistered securities. So really the whole movement in the space is moving towards having a more compliant, a more regulated, and just a more trusted system where, at the end of the day, regulators, they're not bad people. They're there to help protect retail people. Of course, at times they can, stub some of the innovation and be slow. But at the end of the day, some of these features and having things like KYC, AML, or, government and federal insurance backing are there to actually help the users.
Well, I'm going to quickly cut you off there because I think
absolutely.
Let's turn this to more product conversation to begin with and then end on regs. I mean, regs is something we could talk about for a long time. I too am I'm a lawyer by background, so it's something I'm very passionate about. But I think in the interest of the road ahead, I want to focus on the product and what that means for your respective projects. So with the change in market conditions, maybe even change in market participants, how does that affect your roadmap, if at all? I know backstage we talked about privacy. That's something you guys are able to share. But really curious to dive a bit deeper into what that means for you guys as founders and as project leaders.
Okay, so the whole market movement does change the roadmap. I mean, before the bear and also around the bull runs, like we all think about how we grow the users and how we grow all the TVL and all the uses of the liquidity protocols and things like that. But now, since the bear market is coming in and everyone is focusing on building, the user is focusing on learning, right? And they're also focusing on like how to survive to the bear market. So in order for them to survive, they actually need to want to learn more, know more things, understand more about the fundamentals, to protect themselves from the next bull market. Because in the bull market, there's so much opportunities, but also at the same time, there's so much risk, right? So we changed the whole roadmap in order to provide the place on Kyber Swap for users to come in, and then they have a place to learn more about protocols. So that is one. The second one is the place sustainably and consistently for them to make more money, because in the past 2 years, 2022 and 2021, we didn't really deploy that much of liquidity reward. So right now we are using that, to provide huge amount of liquidity mining programs that is gonna last for 1 and even 1.5 years from now, and even more. So that is the focus. We are focusing on providing a place for users to come in, to make sustainable money for a long time, for them to survive through the bear market. So that is the strategy for a very short-term future for Kyber.
Got it. So very economical. Sergey, I know we talked also about all these hacks. You mentioned Wintermute, sandwich attacks happening on, on-chain. Talk us through some of the plans for 1inch without, giving too much away.
Yeah, so sandwich attacks. So if someone don't know what it is, it's when you exchange on Uniswap, for example, or you use other protocols. Someone swap before you and swap after you, and cut your maximal price impact, which you set in the front end of Uniswap, for example. And actually, you lose like up to 1%. Depends on what you swap, which pair. Uniswap tried to mitigate these risks and introduce kind of auto slippage, which set up the maximal price impact which you can accept. The thing is, since flash bots were introduced, there are like hackers who steal money from people, and it's a lot of money. So we did an analysis from our side, and we found out it's a huge problem. And like in a bear market, you need to kind of to be very efficient. You have to become very, very efficient to survive. Yeah, how you Victor said. And in our case, we are also looking how to improve the space, how to make everything efficient, what we are already doing, and what's happening also in the space, how to improve it. And right now, the flash bot is a huge problem. From one side, it's illegal from my point of view that hackers monitor the transactions in the mempool and manipulate the liquidity in the terms that the user get less than they actually wanted. And yeah, we are working right now on a solution for this, so it should come out in the next, I would say, month. And it should also change the space and make the space more efficient.
Very exciting. Will?
Yeah, so I think, in terms of the roadmap ahead, it hasn't necessarily changed too much for us in terms of the bear market. And, what we're doing in terms of the DEX or AMM that we're launching is, because we're licensed and operational in the US, being able to have multi-asset. So I think a big thing for people, especially in the bear market, as you need to be more efficient and smarter with how you're reserving your capital, is being able to have multi-asset. So have public equities, one-to-one backed. You still get voting rights, you still get dividends, but now you can trade against different crypto assets. So I think, whether you're someone that has, Tesla or Google shares on your Interactive Brokers account, and that's just sitting there, now you can actually move it over to an AMM model, be a liquidity provider, and actually earn fees and generate, different profits from people trading within the DEX, or be able to lend those assets out. So, taking a lot of the, not just the DEX, but also just kind of DeFi ingenuities and being able to utilize them for traditional assets as well as crypto assets. So I think, education is still one of the big things, showing people that just holding Ethereum and Bitcoin in your wallet, yes, it's smart and it diversifies your portfolio or even any public equity, but, you could actually have that work. That's in the past been reserved for people with, a certain level of capital or shares or things like this. But now, if you have $100 of Ethereum or Tesla, you can put it into the AMM and earn trading fees, or you can lend it out to other people. So I think this is, definitely one of the big things to educate people within the bear market, to be able to learn that, passive income is something you can do, whether it's with crypto or traditional equities, and DEXs and AMMs are something that can help to, financially include people that, otherwise it used to just go to centralized exchanges.
Got it. So, in terms of the structural barriers, or reducing the structural barriers to adoption, education is obviously one of them. What are your thoughts on the user experience? For a lot of people who might not be crypto native, even interacting from a wallet to a blockchain can be quite scary. So how do we think about that?
Before getting to that question, I want to collaborate a little bit more on the attack surface, because I think the main message for everyone now participate in DeFi and trading is be safe and survive, right? That is the for the bear market. And on the attack that Sergey is mentioned about, sandwich attack is on taker side, which is the trader, right? But on the liquidity protocol side, liquidity provider side, there's also an attack. For example, you put liquidities there, waiting for the fees to be generated. But then before the trade happens, someone just jump it before and put all the liquidities there in order to steal all the fees. And before that, they was able to hatch it as well. So that is one of the attacks. We just launched Kyber Swap Elastic, the protocols, to prevent that. So that is one of the collaboration. Regarding the questions, what is the things that stop or make it a little bit harder for people to really adopt more on decentralized chains, right? I think we have many like internal infrastructures right now, right? Right now, users have to have a wallet. They have to wait for the transaction to be mined, so the user experience is not that fast. This is not that good, and also the users, they are exposed to so many risks. The hacking risk, the risk of being exposed to the data, like they don't have the privacy. Like you keep the wallets, like everyone knows how much money you have. Well, everyone knows like which token you are going to buy. You're buying right now, and at what price, right? That is also one of the things that I think it stops people from using it. So right now, everyone is using decentralized chains is because they find a lot of opportunities in order to make money. This is not really about strategically trading. This is about making more money, obvious money, like with liquidity mining, with all of the marketing and budget and things like that, and also all of the bull run. But then now the bear market is different. So that is with the infrastructure. The second one is with the protection, because they're exposed to so many risks, but they don't really have any guarantees protection, right? For example, if they participate in a protocol and that protocol get hacked, and then the users, they have no idea what is going on, and they have no idea if they are going to be compensated after, right? And when you get into the bear market, you have to survive and you have to be so careful, right? That's gonna be a huge barrier. So I think the next big thing is maybe the insurance things for DeFi. So the protocols, they have to get like some of the treasury, they have to get some of the tokenomic in order to get into insurance, so that users, retail users especially, they can get more guarantee and get more safety. So that is from my standpoint.
So I think, 2 points on that. So one on the kind of the security and insurance. One of the benefits of being licensed under a federal body is having federal insurance backing it. So again, if there are hacks, one with public equities and things like this, when they're on chain, in order to be compliant, especially in the US, you need to have pause mint burn functionality. So if someone does get hacked with their 100 Tesla shares, you can actually burn those and then reissue them to the hackers, the person who has hacked wallet. So having like this kind of backing, as well as federal like SIPC insurance, which comes with federal licenses, definitely helps, and gives some sort of level of comfort for users. But I think yes, it is daunting for people to open up a Web3 wallet. Of course, there are things coming out in terms of social logins and having kind of sharded keys, so that people can actually set up with a Gmail or one of their socials. But again, this goes back to education. There is really a strong move to be non-custodial. Having people control their own assets. We've seen time and time again. Even most recently with Celsius, they claim that the user's capital and the user's money was theirs, but when kind of stuff hit the fan, it ended up being once you deposit into the centralized system, it's actually ours. We control it. So one of the things that users really need to learn is that yes, it is daunting, but educate yourself a little bit to see how it actually works with setting up a MetaMask or a Web3 wallet. But at the end of the day, actually having control of your assets is one of the most important things. And that's, again, even with the ethos of blockchain, not really trusting some of the centralized banks or centralized institutions. This even goes now into different Web3 companies, that you should really have control of your assets. And non-custodial is, one of the best ways to actually be running a platform, and that's why, what we're building on both sides is decentralized in the terms that it's still non-custodial. Users have access to everything at any point, and we don't touch anything. We just provide, the smart contracts, the licensing, and kind of the KYC, AML, and making sure that we're above board.
I would like to add regarding Web3 UX, UI. My first touch points with MetaMask, it was horrible. I am software engineer for like 17 years. I'm full stack, I call it. I I developed front ends. I was a designer, like UX designer as well in previous time. Backend software engineer, and I didn't get it how it works. Like this onboarding is horrible, and what I can share right now from our side, we have built two wallets, iOS and Android wallet, and to improve the space, to onboard more people. So you for example, you can get such a chip on our booth with a real airdrop kind of our tokens to play around with that, and the problem is with Apple Store. Apple Store doesn't allow us to release a new version anymore because they see like you are like doing transactions, crypto transactions in an app, and you should maybe use the in-app purchase to sell NFTs because you have NFTs in your app. And if the people didn't buy the NFT on your app, you have to hide it from, remove it from the wallet. You shouldn't show it in the app. So they actually they don't understand anything about that. And so they're like kind of barriers which we have right now in the real world. This is like Apple who control the app store. There's no additional app stores which you can use. In terms of Google, they're better. They understand it much better. So, for example, we had with my co-founder Anton, we had some presentation on Google Teams and Facebook Teams. They understand it very well, but we have not only to teach the retail people how to use non-custodian wallets and how that they also should understand that they own the keys. If they lost the key, it's a high risk as well. But we have also to teach tech companies like these big companies like Apple, that we are here to stay, and we need the support of these big guys because they control app stores.
No, I agree. I think the application layer is super important, and right now it's being gate-kept. And I think thinking about dApp Store, which I think was what Solana is doing, makes a lot of sense. For a couple of friends of mine at Steppen, they're actually listed as a fitness app, not a wallet, even though it's play to earn, right? So I think it's so important that. It's so important that these people embrace it. Otherwise, you're getting really creative around how to get around it. I do want to touch on institutions as well. We've talked about big tech giants, but let's move to institutions. What's stopping institutions from partaking in trading in a decentralized, non-custodial manner? It's something that we've struggled with. They typically want custodians. Obviously, the smart contract risk, what we've talked a lot about. But how do we get these bigger players on board to platforms like yours?
So I think institution is way different from the retails, right? So for retails, they are focusing on opportunities, learnings, right? And kind of make more money and things like that. But for institutions, they are really looking at optimizations, efficiency, and also protection, right? Which is protection is one of the biggest one. Right now, decentralized chains, and also in general, the DeFi, on-chain DeFi, the protection for institution is not there. When you get institution, normally they goes with high capacity. When you get all the capacity of the money going in DeFi, and then you're exposed to the same risk with those guys, retail guys, right? It doesn't make any sense. So you have to have more protections there, to get more institutions. The second important one is actually the efficiency, right? Efficiency right now, it can come with liquidity protocols, we can come with DeFi protocol in general, but at the same time, it has to come with infrastructure. So for infrastructure, you have to have blockchains or layer 2, layer 3, whatever it is. You have to support on very fast and efficient way for they to participate in the finance space. So that is one. The second one is they have to have that privacy protections, right? Still, again, privacy. Just imagine if you have a billions of dollars and then you deploy it on DeFi and this is exposed to everyone. Everyone knows that you are moving $1 billion from one wallet to another wallet. For example, you're buying some token, right? And then suddenly that is can be seen as a price manipulation or something like that, right? It can be used that way. So I think in order to get more institution to DeFi space, we have to unlock that infrastructure barriers, which is with layer 2, layer 3, and even more like application-focused layers.
Yeah.
And then we have to have more protections, right? Privacy and then insurance, as I said before.
Yeah.
I would like to add, so from my point of view, we need a compliant and regulated environment for institutionals. So right now we have a couple of projects, for example, Oasis Pro in US, they're regulated. They try also to build such an environment where everyone can deploy. And I like this idea because DeFi is about composability. So, for example, like we built 1inch on top of existing protocols and there's also need to have such an environment where everyone can deploy Curve, Uniswap, Balancer, Kyber, and we can benefit from each other and provide great infrastructure, yeah, in fully compliant, regulated manner. For this, we need to introduce KYC ML, yeah, at least for institutions, and I see also in the future that it's possible to introduce also KYC ML in a normal DeFi space. It's kind of then in its permission, yeah. But I guess everyone is KYC'd on Coinbase, Binance, and other centralized exchanges, right? Why not to be KYC'd on DeFi space with an NFT, yeah? Privacy is very important. So for institutions, I agree. Yeah, they need to hide what they do, yeah. We are also kind of. I'm waiting for the new product for Kyber. I heard, yeah, they're working on very nice kind of private solution for trading. Would be great to see that. From our side, so we are working on 1inch Pro, and we try to build such an environment. It's not that easy. It's really not easy. But I think it's possible. So we are also kind of far enough. So we are going to release next year such a solution where everyone can just pass KYB and ML and participate in this compliant environment, yeah, and benefits from DeFi technology.
Yeah, no, I agree. I think in traditional finance, so I was a trader in my past life, they have dark pools, which essentially mask your size, and that allows you to move large amounts of money without the rest of the market knowing or even front-running that information. And similarly for a lot of institutions, they want to see that there are KYC pools. They don't want to be trading with funds that are sanctioned or touch something that they shouldn't have been touched. So there are definitely a lot of challenges. Will, I know there's something that you're quite big on, so I'll pass it over to you.
Absolutely. And I'll be conscious of the time, so I know we're running out. But Sergey, absolutely, I mean, hit the nail on the head. It's legal and compliance. At the end of the day, if you're a listed company, if you're an institution, you can't ever really go on a fully decentralized exchange, something like a Uniswap, because there's just too much counterparty risk. You have no idea who you're trading against. Having licenses and KYCing and AMLing everyone coming on allows institutions to actually come on board and participate within the DeFi ecosystem that's been developed over the last 2 years. We're working with a number of institutions and kind of bigger listed companies, whether it's either on the DEX and trading side or even on the issuance side. The first question that ever comes up is it legal and is it compliant? And if you're able to show that, hey, we have this licensing, everything's KYC, AML, on the issuance side, doing private placements through things like Reg CF, Reg D, Reg S, Reg A+, allows it to actually, compliantly issue tokens to, US and international retail accredited institutions. So that's really been the biggest missing piece is institutions, they want to come into DeFi, they want to be able to participate, and they want to be able to take advantage of a lot of the rewards that are happening with indexes and AMMs. But ultimately, if they don't know who they're trading against, it's impossible for them to do such.
Fair enough.
So licensing, KYC, AML, and having kind of the traditional checks in place is crucial for kind of the next wave of institutional onboarding.
Great. So, I know we're out of time. And let's end on a high note, guys. Love to get your thoughts on what you guys are most excited about in the next 6 to 12 months, whether it be product or something else happening.
Yeah, so from Kyber side, because I just said before, right? Like in the next 1 year, maybe even 1.5 years, we are focusing on deploying the money for user to have like sustainably a place to make more money, enough to survive to the bear market. So that is the focus on for the next 1 year. But let me take a little bit of time, just 1 minute. Yeah, sure.
So from my side, I'm very excited about the merge. Yeah, so we are green now with Ethereum, and in the next 12 months, I would say, we have to innovate. We need to make everything more efficient, and then we will everyone survive. It's not about. I'm not talking about money. I'm talking about the technology itself, DeFi technology itself, and I'm pretty sure this is the future of finance, the decentralized finances.
And so on the Soma Finance side, we're actually gearing up to launch. We'll be doing a Reg CF issuance, which will actually be the first ever compliant U.S. token offering to U.S. retail people within the next 2 months. And then, towards the end of this year, launching the DEX that'll include both crypto assets as well as public equities, one-to-one backed. And then having things like earn and yield type products, but actually having them legal and compliant in the U.S. So it's really exciting to actually start to be able to provide products to U.S. people where they don't have to worry about, the SEC or regulators or, any of kind of the watchdogs touching down on them.
All right, guys. I'm going to have to cut the panel off right now. Everyone in the audience, please give our 3 panelists a big warm applause. Thank you.